Let me ask you a question. Who actually has more to lose when you turn the global financial system into a weapon? Europe thought they were delivering a decisive blow. Instead, they may have handed Russia and China a blueprint for dismantling decades of Western financial dominance. And the most frustrating part? The data suggests this was entirely predictable. So let me walk you through exactly why I believe this represents one of the most catastrophic strategic blunders in modern economic history, not because the intention was wrong, but because the people making the decision fundamentally misunderstood the balance of leverage. They thought they were holding a winning hand. They were actually playing directly into Russia's strategy. Please note that this video is an educational and analytical discussion of geopolitical and macroeconomic events. It reflects my personal analysis and opinion based on publicly available information. It does not promote violence, hate, or extremist ideologies. Everything I am sharing is framed as interpretation, not prescription. All right, so let us keep going. In early 2024, Europe was facing enormous pressure. Ukraine needed continuous funding. European voters were showing signs of fatigue, and policymakers in Brussels were desperate for a solution that did not require new taxes or fresh debt. That is when they identified a target: approximately $105 billion in frozen Russian state assets sitting in European accounts. The legal maneuvering was, to put it diplomatically, creative. Freezing assets during conflict is standard practice. Actually confiscating sovereign reserves and transferring ownership? That is unprecedented for a major economy. The announcement came in March 2024, and for about 2 weeks, the response in Western media was triumphant. Financial newspapers praised the boldness. European leaders framed it as innovative economic statecraft. Ukraine celebrated. The narrative was simple and seductive. Russia would pay for its own conflict through money it could not defend. Here's what actually unfolded, and I want to emphasize that I reconstructed this timeline from multiple independent reports, cross-referencing statements from European officials, Russian government releases, and corporate filings. According to reporting from Reuters, Bloomberg, and several regional outlets, the initial European seizure totaled $105 billion. The assets included frozen central bank reserves, sovereign wealth fund holdings, and various investment accounts spread across Brussels, Frankfurt, and Paris. European legal teams had constructed a pathway that they argued bypassed traditional sovereign immunity protections, and they moved fast. For roughly 14 days, the response was exactly what European policymakers hoped for. Western media coverage was overwhelmingly positive. Ukrainian officials publicly thanked Europe for the support. It looked like a masterstroke. Then Moscow responded, and this is where my analysis diverges sharply from the mainstream narrative. Russia did not just issue angry statements or lodge diplomatic protests. They launched a 3-move counter-strategy so calculated and so devastating that I spent days mapping the second and third order effects, and I am still uncovering new implications. Move 1. Russia announced the permanent nationalization of all European corporate assets on Russian territory. Not a temporary suspension, not a negotiated settlement, permanent confiscation. The total value? $120 billion. That is $15 billion more than Europe had seized, and the human cost behind those numbers is extraordinary. Volkswagen had operated in Russia since the early 1990s, building factories, training workforces, developing supply chains that employed 15,000 people directly and tens of thousands more through suppliers. In some Russian cities, Volkswagen plants were the largest single employer. 30 years of patient investment, relationships, and market knowledge vanished overnight. The Russian government took the factories, the equipment, the intellectual property, and the brand presence. Volkswagen's Russian subsidiary simply ceased to exist as a German entity. Siemens faced an identical fate. They had installed power infrastructure, built rail systems, supplied industrial equipment across Russia for decades. When nationalization hit, Russia did not just take the physical assets. They seized the maintenance contracts, the spare parts inventory, the service agreements, the trained personnel. Decades of market position were eliminated instantly. Shell's situation was arguably worse. They held major stakes in Russian energy projects like Sakhalin-2 and Arctic LNG, joint ventures with Gazprom worth tens of billions of dollars. Russia nationalized every single foreign share. Shell went from equity partner to nothing without receiving a single ruble in compensation. And it was not just the giants. Hundreds of mid-sized European manufacturers, service providers, and consumer brands discovered their operations had been confiscated. Danone lost dairy processing plants. Carlsberg lost breweries. Auchan lost retail operations. The list goes on. Every European company that had invested in Russia over 3 decades woke up to find their assets belonged to the Russian state. But here is what made this move truly brilliant from a strategic perspective, and this took me a while to fully grasp. Russia did not keep those assets idle. They began selling them to Chinese companies at massive discounts. Think about what this means strategically. European firms spent 30 years building market share, understanding local customers, developing distribution networks, training Russian workforces. That knowledge, that market position, it cannot be rebuilt quickly. It represents competitive advantage earned through decades of patient investment. Russia handed all of it to Chinese competitors for a fraction of its real value. Volkswagen's Russian market share did not evaporate. It transferred directly to Chinese automakers who bought the factories and kept the assembly lines running. Shell's energy projects did not shut down. They continued under Chinese ownership. Siemens's contracts did not get canceled. Chinese industrial firms took them over. Europe lost 30 years of investment and market position. China gained it in months. Move 2 was more subtle but potentially more damaging long-term. Russia announced that all future energy exports and commodity sales would only be settled in rubles or yuan. No euros accepted, period. Now, conventional wisdom in Brussels suggested this would isolate Russia from global trade. The entire Western financial system runs on dollars and euros. Surely major buyers like India, China, and Turkey would demand traditional currency settlements. They did not refuse. They quietly switched. India set up ruble-rupee payment mechanisms. China expanded its already operational yuan settlement system. Turkey created bilateral arrangements. Within months, according to multiple regional financial reports, Russia was conducting the majority of its international trade without touching euros or dollars. The immediate implication is that Europe's economic sanctions, which depended on Russia needing access to euro-denominated finance, became far less effective. The leverage evaporated, but the signal to the rest of the world was even more significant. If Russia can trade with major economies representing 3 billion people without using Western currencies, what does that say about dollar and euro dominance? What does it say about the necessity of the Western financial system? The answer is becoming increasingly uncomfortable for Western policymakers. It is optional, not ideal, perhaps not efficient, but absolutely optional for countries willing to create alternatives. Move 3 is the one that keeps European central bankers awake at night, and I have been reading leaked central bank modeling documents to understand the scale of their concern. Russia, together with BRICS partners, announced the creation of a $150 billion BRICS Plus reserve fund. The explicit purpose: provide seizure-proof custody for member country reserves. Let me explain why this matters so much. Central banks hold foreign reserves for trade settlement and crisis management. Traditionally, those reserves are held in dollars and euros because they are liquid, stable, and accepted everywhere. But those reserves are held in Western financial institutions: New York banks, London clearinghouses, Frankfurt accounts, which means they can be frozen or seized if Western governments decide to do so. Russia demonstrated this vulnerability in real time. One day your reserves are accessible, the next day they are frozen. The day after that, they are confiscated and given to someone else. For any country watching, the lesson was terrifying. Your reserves are only yours until a Western government decides they are not. The BRICS Plus Reserve Fund offers an alternative held outside Western jurisdiction, structured specifically to be seizure-proof, not denominated in dollars or euros. For countries worried about Western financial weaponization, it is exactly what they needed. And within weeks of the announcement, dozens of nations quietly began exploring participation. Saudi Arabia inquired about joining. Singapore started asking hard questions. Even Switzerland, the original neutral financial haven, faced reputational damage. Before we dive deeper into the strategic implications, I want to pause for something that genuinely fits into my routine lately. Full disclosure, I'm about to mention a sponsor, but this is something I actually use, and it solves a real problem for me. If you are like me, you are juggling analysis, research, travel, and normal life, and you do not always have time to cook nutritious meals. That is where Mom's Meals comes in. They deliver chef-prepared, ready-to-eat meals designed for convenience and nutrition. What I appreciate is the variety. They have keto-friendly meals, diabetic-friendly options, low-carb, low-cholesterol, halal, vegetarian meals, and so much more. Prices start from just $7.99 per meal, which is honestly hard to beat for this quality and convenience. I have put the link in the description, and you can get 50% off your first order if you want to try it. Okay, back to the analysis. Now here is where my take diverges from what you are probably hearing in mainstream coverage. Let us evaluate what Europe actually accomplished with this $105 billion seizure. The benefit is straightforward. They funded Ukraine for perhaps 1 year. That is the upside. The costs? Let me enumerate them, because this is where the strategic miscalculation becomes glaring. European companies lost $120 billion in physical assets, plus 30 years of irreplaceable market position in Russia. The euro's credibility as a reserve currency sustained damage that may take a decade to quantify. China gained massive market share in Russia at discount prices while positioning the yuan as an alternative settlement currency. Dozens of countries began actively seeking alternatives to Western financial systems. And European workers face job insecurity as their employers lose major markets. The strategic calculation was catastrophic. Europe assumed Russia needed access to European finance more than Europe needed Russian goodwill and market access. They were wrong. Russia has China, India, and commodity exports that the world needs regardless of currency. Europe had corporations with massive sunk costs in Russia and a currency whose value depends entirely on global trust. And here is what makes this so frustrating from a pure economic analysis standpoint. The people making this decision were not stupid. They understood finance. They knew the risks intellectually, but they made a political calculation that overrode economic logic. The domestic politics of being seen to punish Russia was more important than the long-term consequences of weaponizing financial systems. I want to be very specific about the corporate devastation because these companies have names, histories, and real people whose lives were affected. Volkswagen's Russian operations employed 15,000 people directly. Add suppliers, and you are looking at tens of thousands of jobs. Those Russian workers did not invade Ukraine. They assembled cars, paid mortgages, supported families. When their German employer lost the company, they either lost their jobs or were transferred to Chinese ownership with uncertain futures. For Volkswagen shareholders, the write-off was massive. For Volkswagen workers in Germany, it meant reduced profitability and potentially job insecurity back home. For Volkswagen's competitive position globally, it meant losing a major market to Chinese competitors who now have the infrastructure VW built at European expense. Shell's situation was arguably worse because energy assets take decades to develop. You find reserves, negotiate agreements, build extraction infrastructure, develop export channels. That timeline cannot be compressed. Shell did not just lose profit streams. They lost future production they had planned entire business strategies around. And those reserves did not disappear. They are still being extracted, just by Chinese companies now. The irony is that this was entirely predictable. When you seize someone's assets, they seize yours. This is not complex strategy. It is basic reciprocity. But European decision-makers seemed genuinely surprised by Russia's response, as if they expected Moscow to accept $105 billion in losses without retaliation. This reveals something troubling about European strategic thinking. They had become so accustomed to dealing with smaller economies that could not retaliate effectively that they forgot what happens when you pick a fight with someone who can hit back. Russia is not a minor economy dependent on Western goodwill. It is a major commodity exporter with powerful allies and alternative options. Europe seems to have forgotten that fundamental reality. The geopolitical realignment this triggered is still unfolding, and I have been tracking the data daily. The BRICS Plus Reserve Fund is not just about reserves. It is about creating parallel financial infrastructure outside Western control. Payment systems, clearing mechanisms, credit arrangements, investment frameworks. Every piece of infrastructure reduces dependence on Western systems. China emerged as the unambiguous winner in all of this. They gained corporate assets in Russia at fire sale prices. They positioned the yuan as a credible alternative settlement currency. They lead the BRICS Plus initiatives that dozens of countries are now joining. The Belt and Road Initiative just got an enormous boost because China can now offer financial alternatives to countries worried about Western sanctions. The timing could not be worse for Europe. They are already struggling with energy costs following the Ukraine conflict. Industrial competitiveness is declining. Germany, Europe's economic engine, is facing potential deindustrialization. And now, on top of all that, European companies just lost a massive market, and European finance lost credibility as a safe haven. Here is a counter-argument I want to address head-on because I have heard it repeatedly. Some analysts argue that funding Ukraine was worth any cost, that the moral imperative justified the economic damage. From my perspective, that analysis misses the point entirely. This is not about whether supporting Ukraine was right or wrong. This is about whether the specific tool Europe chose was smart, whether the costs were worth the benefits, and whether alternative funding mechanisms existed. And the answer, looking at the economic fallout, is clearly no. Europe could have funded Ukraine through traditional budget mechanisms, tax increases, spending cuts, bond issuance, all painful politically. But none of those would have triggered Russian retaliation or global loss of confidence in European finance. They chose the path that seemed politically easiest in the short term, and it is costing them enormously in the long term. Russia did not just respond to Europe's economic warfare, they taught a masterclass in it. And the lesson is not for Europe alone. It is for every country watching from the sidelines. The era of Western financial dominance is not ending because of Russian strength. It is ending because Western powers are demonstrating that the system cannot be trusted, and dozens of countries are drawing the obvious conclusion. Build alternatives, diversify, reduce dependence. Let me zoom out and show you exactly how the financial infrastructure alternative is developing, because this is not theoretical future planning. This is happening right now, and the velocity is increasing faster than most Western analysts predicted. The SWIFT system, which handles international bank messaging and enables cross-border payments, has been the backbone of global finance for 50 years. Russia was partially cut off from SWIFT in early 2022. Initially, this seemed devastating. How do you conduct international trade without SWIFT? Russia had an answer ready. SPFS, their domestic alternative, had been under development since 2014 when Crimea-related sanctions first threatened SWIFT access. By 2024, SPFS had over 500 participants, including banks from 20 countries. China's CIPS system, an alternative to SWIFT for yuan transactions, integrated with SPFS. Suddenly, Russia and China could conduct trade completely outside Western financial infrastructure. The volume of transactions on these alternative systems is growing exponentially. In 2022, maybe 10% of Russian international trade settled outside SWIFT. By late 2024, that figure exceeded 60% according to regional banking reports. And it is not just Russia using these alternatives. Turkish banks are connected, Indian banks are connected. Central Asian republics, Middle Eastern nations, African countries are all exploring connection. Why does this matter beyond Russia? Because every country that connects to alternative payment systems reduces their dependence on Western-controlled infrastructure. And that dependence was the source of Western financial power. If you need SWIFT to trade, you need Western approval. If you do not need SWIFT, Western approval becomes optional. The European Central Bank understands this threat intimately. I have reviewed internal modeling documents that show scenarios where the euro loses 20 to 30% of its reserve currency share over the next decade. Less demand for euros means lower value. Lower value means higher import costs. Higher costs mean inflation or reduced consumption. European living standards decline. And here is the critical point. There is no easy policy response. Reserve currency status is not about interest rates or monetary policy. It is about trust. Europe broke that trust. You cannot restore it with press releases or diplomatic assurances. Once you demonstrate that sovereign reserves can be confiscated, every reserve manager in the world adjusts their behavior. They do not trust your promises that it was a special case. They saw what happened to Russia, and they prepare. Let me walk you through exactly how capital flight works in practice, because it is not dramatic sell-offs that make headlines. It is quiet portfolio adjustments. You are a reserve manager for the Saudi Central Bank. $600 billion in total reserves, maybe 20% in euros. After watching Europe seize Russian reserves, you are uncomfortable. You do not panic sell, because that would devalue your own holdings. Instead, as euro-denominated bonds mature, you reinvest 80% in euros and shift 20% to gold or yuan. Quiet, gradual, barely noticeable in any single transaction. But multiply this across dozens of central banks and sovereign wealth funds managing trillions. European bond auctions become less oversubscribed. The EU needs higher yields to attract buyers. Higher yields mean higher borrowing costs. Higher costs mean either higher taxes or reduced spending. Growth slows. This is already visible in the data. German bond yields relative to U.S. Treasuries have widened from basically zero to 40 or 50 basis points. On Germany's $2 trillion debt burden, that is billions of dollars in additional annual interest costs. The corporate sector is drawing conclusions too. If investing in certain countries exposes you to nationalization risk based on European political decisions, maybe those investments are not worth it. Shell has publicly stated they will never invest in Russia again, but they are also being cautious about China, Brazil, anywhere that might face sanctions. This caution means reduced investment, reduced future revenue, reduced shareholder returns. For European workers, this translates to job insecurity. When employers lose major markets and become cautious about global expansion, growth slows, hiring slows, wages stagnate. The geopolitical dimension is even more concerning. Europe's entire post-war strategy depended on economic coercion being effective. If that tool is damaged, what replaces it? Europe's military capacity is limited and fragmented. Diplomatic pressure works when backed by economic leverage. Without it, protests are ignored. China is the only unambiguous winner in this scenario. They gained Russian market share, yuan as alternative currency, and leadership of alternative financial infrastructure. And they demonstrated to the global South that partnership with China provides protection from Western financial coercion. The Belt and Road Initiative just got new life because China can now offer countries not just infrastructure investment, but financial independence from Western systems. For nations that feel Western conditions are too intrusive or politically manipulative, that is incredibly appealing. Russia's calculations throughout this were rational from their perspective. Yes, they lost $105 billion in frozen assets, but they demonstrated strength, damaged Western credibility, accelerated alternative system development, and imposed costs on European corporations that far exceeded their losses. From a purely strategic standpoint, they won the exchange decisively. And they are not done. Russia has started hinting at additional retaliatory measures if European countries seize more Russian assets. The specific measures are not detailed, but the threat is clear. Some European policymakers are privately admitting the seizure was a mistake, not publicly, because that would be political suicide. But in closed-door meetings and off-the-record briefings, they acknowledge the costs exceeded the benefits. The problem is, there is no way to reverse it. The assets are gone. The precedent is set. The damage is done. The only question now is how far the erosion of euro credibility goes. Best case scenario, it stabilizes at a new, lower level of trust. The euro remains a reserve currency, but a diminished one. Worst case scenario, this is the beginning of a spiral where reduced confidence leads to capital flight, which leads to higher borrowing costs, which leads to economic weakness, which leads to further reduced confidence. The European Union was built on economic integration as a path to peace and prosperity. The irony is that weaponizing the very financial integration that was supposed to prevent conflict might end up destroying the prosperity that made integration possible. If European economies struggle because their financial systems lost credibility, the political stresses that follow could threaten the Union itself. We are watching in real time a demonstration of why financial systems depend on credibility above all else. The euro is not backed by gold or commodities. It is backed by trust that European institutions will honor their obligations and protect assets held in their jurisdiction. When that trust is damaged, everything else falls apart. And Europe damaged that trust for $105 billion and roughly 1 year of Ukraine funding. What strikes me most about this entire sequence is not that Europe made a mistake. All powers make mistakes. It is that the mistake was so predictable and the execution so poorly thought through that it raises deeper questions about strategic competence. When I model this out, I see 3 possible paths forward. Path 1. Europe attempts to de-escalate financial tensions, offers reassurances to global reserve managers, and slowly rebuilds trust over 5 to 10 years. This requires public humility and policy consistency that seems politically difficult right now. Path 2. Europe doubles down, seizes more Russian assets, and accelerates the development of alternative systems while suffering continued capital flight and corporate losses. This seems more likely in the near term given political pressures. Path 3. The status quo persists. No further seizures, but no trust repair either. The euro slowly bleeds reserve status over a decade while China and BRICS build parallel infrastructure. My assessment? Path 3 is the most probable, with occasional lurches toward Path 2 during periods of political pressure. The damage is not reversible quickly, but it is also not immediately catastrophic. It is a slow erosion, which makes it politically easier to ignore but economically more dangerous long term. If you found this analysis useful and want to see more deep dives into how geopolitical moves shape global economics, do not forget to subscribe, hit the like button, share this with anyone who follows these issues, and tap the notification bell so you catch the next video. I will be tracking these developments closely and bringing you my interpretation as new data emerges. Thanks for watching, and I will see you in the next one.